All
All
right.
right. Well, thank you, everyone. My name is Johnny Mateo, and I've been in the mortgage industry since 2002. So it's been a long time, 22 years, where I've seen the ups and downs of the mortgage industry. I'm a Penn State graduate and originally from New York City. Now I'm living happily in Happy Valley.
Yeah. Well, thank you, Johnny. Shane, well, thank you for filling in for Joel tonight. So Shane is the CFO for Timberland Federal Credit Union. And Shane, give a little bit of background on yourself and how you end up where you are today.
Well, apparently 2002 was a big year for both Johnny and I because that's when I started in credit unions. So I've been in credit unions now for 23 years. I'm also a Penn State grad and living happily at home with my wife Laura and our three golden retrievers.
I thought you're living at home with your parents, you're going to say still, but
No, let's hope not.
Hey, save a lot of money that way. But well, yeah, I mean, I started my banking career in 2001, so almost 75 years of experience between the three of us. As the team here at the Timberland Federal Credit Union in Pleasant Gap says, I've been around for a while. That's what they tell me. So yeah, today we're going to talk a little bit about the refinancing in today's financial landscape when it comes to mortgages. Shane's going to talk a little bit about investing in the today's market and inverted yield curve. As a CFO, he has a little more experience about that than I do. But Johnny, let's go with you. What is I guess that's the biggest thing when I talk to my friends and family. There's all this news talking about the Federal Reserve lowering interest rates and like that, but they're saying, well, hey, wait, mortgage interest rates aren't coming down. So I guess, Johnny, explain to me when it says that the Federal Reserve is going to lower interest rates and what effect or non-effect that has in the mortgage rates.
Okay, well, there's actually a difference, and there's between the what the Federal Reserve does and what mortgage-backed securities do. They're supposed to work independently. What we've seen is over the last number of years is they work in sympathy with each other. So as the rates are going up, the cost of everything is going up, which then in turn, with the inflation, has affected the interest rate. So there are times when the Federal Reserve does something and it automatically just affects all interest rates, whether it's on credit cards or on mortgages, but it doesn't always work that way. There are other things at play when it comes to mortgage-backed securities. Mortgage-backed securities are a lot like other bonds or securities where if the stock market is not doing great, there's a thing called flight to quality. People will move to fixed assets, which that's what mortgage-backed securities are. They're a tradable asset. So just watching what's happening on TV doesn't always translate, and this happens all the time because something good will happen in the market, and someone will call me and say, "Hey, I just saw the interest rates drop." Well, technically, no, they didn't, but they do tend to trade in concert or in sympathy, actually.
Okay, sympathy. All right. Well, thank you for that. So I guess the other question to lead up on that is, a lot of people have a 2.25%, 2.5%, mortgage rate right now, which we're not seeing. We're seeing rates, I assume, so close to 7%. You can correct me on that. So where do you expect maybe in 2025 where we're going to see mortgage rates sort of hover around?
Well, I don't think that in 2025 rates are going to hover. We're going to see, we're going to have some whiplash this year with the new administration putting in there's whether they are with tariffs, the scares of tariff, or whatever's going to happen in the economy. I think it's going to make it that we're going to have some ebbs and flow in the marketplace. I do feel that in the short term, probably in the next couple of months, we should see the rates peak back into the fives, but I would not fall in love with that trend, and I see it coming back once we see if the price of eggs, everyone talks about that, right? If the price of eggs don't come down, if they don't, we're going to see how that's going to infiltrate other parts of the economy, and housing is one of them, especially if we have any tariffs with Canada, because we get most of our lumber from Canada. So the cost of building a home increases, which then in turn makes your home or the home of the seller a little bit more valuable, and we'll see the prices go up. And once again, if prices start going up, that's inflationary. So we should see the rates then unfortunately go up as a result of that.
Okay. I'm reading a lot of things, talking to members, reading a lot of things online that we have a lot of people sitting on high interest credit card. Debt, credit card rates, in credit, we can't charge more than 18%, but there's credit card companies out there charging, 20s and 30% on a credit card. Now, I'm sitting on possibly a lot of equity in my home. So what are some of the potential risk if I delay refinancing my home and maybe taking some of the cash out? Maybe I'm afraid because I have a 2.5% interest rate, but I have a 30% credit card with $10,000 on it. So what are some of the potential risks I have by delaying refinancing my home because I'm waiting for rates to come down again?
Well, there's a lot of risk because rates. I personally, and I think a lot of the experts in the industry believe that we won't see 2% again on purpose. 2% interest rates has destroyed the move up buyer market in our industry. So people aren't selling their homes because they need an extra bedroom or an extra bathroom. They're just dealing with it because they have such a great rate.
Right.
Okay, so the risk is that you're going to be carrying credit card debt, paying more money. You'll have more money outlay on a monthly basis by not refinancing, just because you love to be able to tell people that you have a 2.5% interest rate because you feel that that it's saving you money. When if you were to look at your entire debt schedule and see how much you're shelling out, and if you were to refinance or even get a line of credit or a home equity loan to consolidate those things, so then those debts, so then that way you can lower your monthly outlay. I think that's the smart move. Smart money tries to pay as little monthly as possible, not just on one debt. That one debt it's great that you can tell someone that you have this sexy interest rate. But in the end, if you're shelling out more money than you're bringing in and you're going into further debt, it's not doing you any good.
Okay. Yeah, good advice there. So if I'm coming to you and I have that sexy interest rate of 2.5%, but I have other debt, the outlay, what are some of the things you help me determine if refinancing is the right option for me at this time?
What I do is I take your first thing I'll do, I'll take what your current monthly payment is on your mortgage. I then look at the debts that you're carrying. I add those up and see what is that monthly nut that you're paying on every single month. Then what I'll do is I'll consolidate. I'll take all that debt, put it into a mortgage, which then of course eliminates that minimum payment that you're probably making, because we all make that minimum payment if we have to. And then I'll see if there's a savings on a monthly basis. If there's very little savings, I wouldn't refinance at this time. I would wait until it goes into the fives. So there's a certain amount of money. I always use this line that when someone says to me that $100 is not enough for them to refinance, I always tell them, if there was $100 bill outside your door every single month, would you bend over and pick it up? And the answer, they always say, yeah, I'd pick it up. Well, then pick it up, because you're saving that kind of money now. So refinancing, if the numbers make sense at $100, it makes sense. $100, you have to make about $130 at work after taxes. Then you may get 100. So you got to look at that as well. The number of hours you're working to pay this one debt. I think any savings at over $100 is well worth refinancing.
No, so they're talking to a financial advisor. Maybe they're in that retirement red zone 20 years from retirement, and you can put that $100 a month back into your retirement, and what that compounds over the next 20 years. That's a significant amount of money now towards your retirement. And,
absolutely. I think a lot of people just are very they're optimistic. As Americans, we tend to be optimistic that things are going to get better. So they always think that, well, I'm going to leave my mortgage alone because I'm going to pay off that debt. Yeah. Paying off credit cards, especially once they've gotten out of hand, is one of the most difficult things to ever do, is to pay down a credit card where you have 28, I think the average interest rate is like 26 to 28% right now. It's impossible to pay that thing back unless you pay it back in like a large sum of money.
Yeah, I don't think people really look at that box there, how much it's going to cost you if you make the minimum payment. What's this going to cost you to pay this off in the next 20 years? Yeah, what the interest is going to calculate at, and to make it so easy just to make that minimum payment of $25 or $30, and okay, well, now I got this as a cash flow, I can take care of the things, but you're never going to pay that
It's a
off.
slow boil, isn't it? It's
Yeah,
a slow boil.
So, what are some of the steps involved when it comes to the refinancing process?
It actually very simple. You complete an application. Doesn't take long. Takes about 10 minutes. You could do it either online or we do it over the phone. We do a soft credit pull. It does not affect your credit score. We peek into what your credit score is and what the debt load that you have. So then that way we can do the calculation and run the estimate to see if it's worth financing now or having a strike point at which then we will exercise that rate. So if if we do we run the rate now and the rate is 6.5, but you'll actually start saving money when you reach 6. We will put an alert on there, and then once it reaches 6, we can lock it and go through the process of refinancing it. Some of these right now, we're getting appraisal waivers automatically, meaning that the system finds that the appraised value that you currently have is perfectly fine, and we can refinance without an appraisal in many cases. If you have an FHA loan or a VA loan or USDA, we can do what is called a streamline, which requires no income, no appraisal. So the appraisal is waived, and so is the income because you already been making your mortgage payment. It's just lowering it, and that's called a streamlined version. So we have a lot of options for the refinance.
Okay. Well, I guess a couple follow-up questions on that. So you said about a soft pull. How could refinancing affect my credit score?
Refinancing will only affect your credit score if you get multiple in a short period of time. The system, all credit reports work off of an algorithm, and they have speed. They put up speed bumps for you. If they see that you're getting your credit pulled by a lot of places, they slow you down by lowering your credit score. It's one of those. It happens with, especially, have you noticed when you buy a car and you go to a dealership and that dealership throws your name, your social security number, social security number to multiple of their investors, and all of a sudden your credit score drops, is because you can buy multiple cars at multiple dealerships, and it's to keep you from being able to afford it. Well, actually, it'll deny you if you have too many credit pulls. Most likely, they'll say, "Oh, wait a second, what's going on?" It makes us research more on what you're doing with your credit.
Okay. I'm talking about credit, and we get members come into credit union all the time, and we're talking about refinancing maybe an auto loan. So I have a credit score of 750. Of course, we pull their credit, and maybe it's 720, and try to explain to them that their Credit Karma, Savvy Money, even the credit score on their Equifax application is not the same as the credit score that you get from pulling. Can you explain sort of the difference between what you're seeing on the Credit Karma and Savvy Money compared to the credit score that you would use to approve a mortgage?
Yeah, so the credit scores that we use are ones that we have to pay for these. Credit Karma, notice you get it for free. Well, the information for them to be able to give it away for free, that means that they're just gathering up information and kind of running their own algorithm. But it's not the true FICO scoring system, and the credit, and not using the type of credit report that mortgage companies and car companies and local banks are using to approve you. So there's always probably a good 40 to 50 point disparity between what you'll see on Credit Karma and what you'll see on a real credit report.
Yeah, I tell members, they ask about, and I have my Credit Karma app on there. I like just to look at it on a monthly basis, or when I get the changes, hey, your credit score changed by 2 points. I don't care about that. But if I get an email saying that my credit, or text saying my credit score dropped by 50 points, that's a red flag for me to look and say, hey, what could have caused my credit report drop by 50 points? It could have been fraud. Somebody opened a new account in my name I wasn't aware of and didn't pay it. So I use it more just of a red flag and say, hey, I need to look into it. Then I may go on to annualcreditreport.com to pull my actual credit report and and check on it. But yeah, we get a lot of people. Again, thanks for that answer. We get a lot of people inquiring, and we tell them their credit score. So that's not what Credit Karma said. That's not what they said on Savvy Money. So thank you for the answer. I guess one of the last questions I have for you is, what alternative strategies can homeowners use to save on their mortgage if they choose not to refinance?
Well, a line of credit or a home equity loan. It won't touch your first mortgage. All right. If your rate is fantastic and it would be cheaper or better for you to get a line of credit, I would rather do that than touch the first mortgage. Because sometimes there's a law of diminishing returns. So if I refinance you and put you in 6, now I may have a 3-4 point disparity as far as interest rate level that gobbles up the savings I would have had I just gotten you a line of credit. Now, the only thing though, it's important to know, is that with a line of credit, the most of the time it's a teaser rate for a period of time, introductory rate that a local bank will give you. So then that way you can get it set up, and then it goes into the normalized rate. And lines of credit are based mostly on the Fed funds rate, on the lending rate +2, right? So right now they're running 9 to 9.5% interest rate as a national average on a line of credit. But home equity loan is fixed. If you get a home equity loan, it can be anywhere from 10, 15, 20, 25-year amortization. Those things too affect your monthly in your pocket savings. It'll save you money by doing it because the interest rate is going to be far less than your credit cards. But that doesn't mean that it's going to be realized in your pocket. So the amortization, the length of time that you take out that home equity loan, will make a difference on the amount of money you put in your pocket.
All right, thank you. John, I asked you some questions here. There might be something that maybe I didn't ask you. You're just a desire that you want to let our viewers know about when it comes to mortgage. So anything else you want to share?
Yes, basically is that those who are waiting for the rates to go down to the 4s or 5s, you may be waiting a long time. 5s, I don't think it's too long before it peaks its head into the 5s. It's not going to drop into the low 5s. During that whole time, you're missing out on appreciation of the home while paying off someone else's mortgage. I'm a believer that smart money always buys, no matter what the interest rate is. There's going to be a time that you're going to get to refinance and take advantage of the low rate. I don't think that you should sit on the sideline, because the moment that you feel, because you heard great news or the economy has turned or the interest rates have dropped, that means that everybody else that thought the same thing is going to jump into the market, and it's going to increase the values of the home. So you'll be buying homes at a higher price by waiting than if you did it right now. So I say smart money buys now, always be buying, make that move if you need to make that move.
All right, Johnny, thank you very much. So, Johnny, if any of our viewers, listeners want to contact you for more information, if something piqued their interest, how do we contact you?
You can, look us up obviously on Google. Core Mortgage Services, out of State College. Our phone number is 814-272-0125, or you can go to the website at coremortgageservices.com, all spelled out, coremortgageservices.com. You can fill out an application there. You can send us a message, an inquiry, a scenario, anything, and we'll run numbers for you.
Johnny, as always, thank you. You're always a wealth of knowledge and been you're helpful for me over the last 20-some years that we've known each other. So thank you very much for that.
You're welcome. Thank you.
Yeah. Now we go to Mr. Shane Pence here and talk a little bit about CDs, or here at the credit union, we call them share certificates, and how investors and savers are thinking about right now. Shane, start I guess explaining what is a CD or share certificate and how it works.
They're basically what we call in the industry a time deposit. So you're handing over your money for a certain amount of time, whatever time you want. They come in various terms. They can be as low as 30 days, 60 days, 90 days. You can get them up to 7 to 10 years as well. So you're handing over your money for a certain amount of time.
Okay. So I mentioned, you and I have talked to you since we worked together, inverted yield curve. So how is that affecting the CDs now compared to what and when a normal time would be?
Well, an inverted yield curve means that short-term rates are actually higher than long-term rates. Typically, in history, long-term rates, you're going to earn more money the longer you leave your money in a certain product. But we have been now in an inverted yield curve for a couple years, and what that means is short-term rates are higher than long-term rates.
Thank you. So is there a difference between a CD at a bank and a share certificate at a credit union?
The only difference is name. At a credit union, you have to have a share, so we call it a share certificate. In a bank that more people might know, it's called a certificate of deposit, but the only difference is in name.
Okay. So if I'm coming in, maybe I get my tax refund coming up, and I'm fortunate to get a couple $1,000 return here. Why would I want to consider a share certificate over a savings or a money market, or would I?
Well, they typically offer higher interest rates would be the biggest reason why you would want to do that. A lot of it just depends on personal preference. If you have a project coming due, you can put it, especially right now with short-term rates being longer, you could put it in a share certificate and earn more money than you would on your just general checking or savings account.
Okay. So we talked to members again, this inverted yield curve, like where the short-term interest rates are higher. And maybe they have a sum of money they've gotten from inheritance, say $10,000. Would you recommend they put that into one single CD for a one term, or should we, in our industry, call it ladder that CD? What are some of the considerations when it comes to that?
Well, a lot of it, again, it just depends on what you may have that money earmarked for. The best thing to do is to do what you said and ladder it. And by laddering, we mean that you're going to have, if you have $10,000, you're probably going to get 4 different maturities. We're going to say 6 months, 12 months, 18 months, 24 months, and you're going to put $2,500 in each of those so that every 6 months you have $2,500 maturing rather than $10,000 all at one time.
Right. And when I talk to members and explain that process, one of the reasons, again, every 6 months you have money maturing. If you don't need it, you can rest it for another 6 months, and then you just add that for another 6 months. But also, when it comes to a certificate of deposit, if you need to close that before maturity, explain to what happens if I have a $10,000 CD and it's not mature. I need $2,500 of that. What happens in compared to if I had a shorter term CD?
Well, there's something that's called an early withdrawal penalty, an EWP. And at Timberland, right, it is 180 days of interest you lose if you want to take that money back out before it matures. So if you were to take that money out, it's a whole lot less to take it out on, using the previous example, $2,500 get hit with that penalty rather than $10,000. That's going to be a rather large sum of money that you're going to lose out on. So laddering is not only good for maturities, but also it is a good idea if you think you may need some of that money early.
Okay. So I have a share certificate for 6 months and it matures. What happens at maturity and what options do I have?
Well, if you do nothing with it, it will roll right into another 6-month share certificate. You're given notice in advance. Actually, at Timberland, we'll call you and let you know that you have an upcoming maturity and what do you want to do with that. So, like I said, if you do nothing with it, it'll just automatically roll into another share certificate. It'll just automatically roll over and over and over until you decide to do something different with it.
Yeah, I guess the drawback on that. So, for example, maybe you have a 6-month share certificate that's maturing. And if you do nothing, you have a 10-day grace period to do something with that money. You do nothing, and it rolls into another 6 months share certificate. Well, the credit union or the bank you're working with might have a 7-month share certificate that much pays you a much better rate because they have a special for that time. So now you missed out on the opportunity to have a much better interest rate. So I always recommend the members, and here at Timberland Federal Credit, we reach out to our members, let them know we call them, not just send a letter, we call them and know their share certificate's maturing, but then also, hey, here are the options. And then you make a decision based off of the option. Hey, I don't need this money, so maybe you can put it in for a longer term, and maybe the yield curve has changed and long-term money is better than the short-term money. So my recommendation is talk to your bank. Don't let it just roll over because you may not be getting the best return on your investment. Who should be investing in share certificates or CDs?
Anybody that has the ability to do so. There is no, I mean, once I believe you have to be 18 years old to open a share certificate. But once, if you have money that you don't believe you're going to need for a certain amount of time, open up a share certificate. It's going to earn you more interest than if you just leave your money sitting in your checking or savings account. So really, anybody who has extra money, and like you had mentioned earlier, income tax refund time, that is a great chance to stow away some money and earn some extra interest.
Yeah, and you earn that money and extra interest to put down a down payment to buy a house with Core Mortgage Service.
Yes.
To help get the down payment saved.
There you go.
Yeah. So Shane, also, how do I purchase a share certificate or a CD?
You can just stop in at any of our branches. Just say what you want to do. One of our member service representatives will be glad to help you. They can discuss the various terms we have, the various interest rates we have, and it's really it is up to you to decide what you want to do with your money. But really, just stop in at any branch, and they'll be able to help you.
Okay, and then also there are really two types of CD to share certificate. You have your traditional, and you have a Roth or a traditional IRA certificate also. I guess we explain a little bit what made the advantages, or who would recommend opening an IRA CD or share certificate.
Well, if you want to go with the Roth route, we're talking about tax differences. With Roth, that money is tax deferred. So any income you make on that, that's going to be tax deferred on down the line. Whereas a share certificate, you're going to be taxed immediately.
Okay, so they can go open a regular certificate of deposit, or a share certificate, or a CD, and then also they consider, hey, I'm going to put this for investment. Then they can decide if it's going to be a Roth or traditional IRA share certificate or a CD as well.
Correct.
Okay. So Shane, we talked earlier. You've been here working for credit unions since 2002. I started my career working for large, big banks, and basically for a year now, I've been with Timberland Federal Credit Union, and made the move to the credit union movement. So I guess, in your words, why would I want to move my deposits to a credit union, but also why it would be Timberland Federal Credit Union?
Well, typically, credit unions offer higher interest on deposits and lower interest on loans. So that is a starting point right there. And at Timberland, we also offer a high rewards checking account, which not many banks do that as well. At Timberland, you're going to walk in. We're going to know your name. You're more than a number to us. It's more personal service. And like you had mentioned earlier, when you have an upcoming CD maturity or IRA maturity, we will call you in addition to getting a letter out to you. So it's definitely a much more personal experience.
And one thing, before coming to work at a credit union, I really didn't understand when, I would have my friends or family members telling me that, credit unions are not-for-profit organizations. So maybe explain to me, what does it mean by a credit union is not for profit?
Well, basically that means that we are not taxed, or that we are tax exempt. Believe me, we do have to make a little bit of money. So not for profit means we don't want to make any profit. That is a bit of a misnomer. We are tax exempt under the Federal Credit Union Act, which means we don't pay sales tax and we don't pay any income tax to the government, which is part of the reason that we can then offer higher rates on deposits and lower rates on loans.
And of course, lower fees. I guess,
lower fees.
Yeah, in my career, I think one of the things I realized is, you're here for a year now, when a credit union does well at the end of the year, our members benefit. Our members are our owners. And some of the large banks I work for, their goals were maximize profits, and of course the shareholders do well. Which, hey, if I'm a shareholder at a bank, I want to do well. But here we can help our communities a little bit better, I think. So, thank you for that. So, Shane, anything that I didn't ask you that you're dying to tell our listeners, our viewers?
No, I think you covered it pretty well. Like I said, we had talked yesterday. We had our grand reopening, or actually a soft opening in Pleasant Gap, and we've tried to tell people we feel like we're Central Pennsylvania's best kept secret. So we're just trying to get the word out. If you've had a good experience with us, just please spread the word.
All right, Shane, thank you very much for that. Well, Johnny, before I wrap it up, anything that maybe came to mind as Shane was talking that you want to talk about, or anything in the mortgage industry that we didn't cover that you came to mind?
No, everything. We went over everything there. He did a great job.
Yeah. Well, and again, Johnny and Shane, thanks for filling in this quarter, I guess, as we do these presentations. But feel free. Johnny gave his contact information. Johnny, you want contact information one more time?
Yes, it's our phone number here at the office is 814-272-0125. That's 814-272-0125. And then our website at Core Mortgage Services, plural.com.
It's on the wall over your right shoulder as well.
Yes.
Core Mortgage Services. All right. Well, Shane, we can see you're a Penn State fan with the Penn State Nittany Lion logo over your shoulder. But if somebody would like to contact Timberland Federal Credit Union, how would they contact Timberland Federal Credit Union?
Phone number is 814-371-2676, and you can get us on the web at timberlandfcu.org. You can also find our YouTube channel. We have a TikTok page. We've got a Facebook page. Plenty of opportunities to see what we have to offer.
Again, Johnny, Shane, thank you very much for your time this quarter, and look forward to upcoming topics here in the next quarter once we decide what that is, and we'll be back here again next quarter. Thank you, everybody, and have a good night.
Thank you so much.